generally speaking, I don't expect any sort of major surprises going into the reporting season. The predictability of the cash flows, the data releases that come out during the period, the investor days that have been undertaken by a couple of the companies, and also just the reaffirming of guidance statements really reduces the risk going into the reporting season. So what I'm going to do, I'm just going to do a quick sort of around the grounds on what I'm looking for each stock and what my investment views are, just heading from top to bottom on that table there. So first up, APA. Look, probably if it was an ongoing business, I'd be focusing on the FY19 guidance statements. However, with the Hong Kong takeover bid, really the historical result and even the short-term guidance is sort of secondary to what's going to go on with that bid. As I've said before, from a risk management perspective, if you've held the stock for some time and made a decent profit, I'd be talking to your clients about potentially taking some off the table. If the bid gets blocked, I reckon the share price is going to go back down to that mid to low $8 range. Personally, I think it's got a better than even chance of actually getting through, hence the ad rating on the stock. That's a sort of a 14% upside at current share prices. And given just what happened with the Duet Group, there was an indicative bid came out in December 16. There was approval by the government in April. There was a deal done in May. So if we're sort of thinking about that timing, we're probably only looking sort of 2, 3, 4 months out. So pretty quick upside if you get that sort of timing coming through. AusNet, it's a March year end, so no new news coming out, but certainly my more favoured of the regulated utes out there at the moment. But I won't sort of touch on that given there's no new news coming through. Spark, half year result, likely to be a sort of a flattish profit result. Look, I've got concerns about the sustainability of the cash flows towards the end of this decade and going into the next, and that sort of then feeds through into the distribution, how well that can hold up. I'm going to be looking for comments on their tax paying status. They mentioned that they're going to start paying tax. They didn't know when, they didn't know how much at the full year results, so something I've been looking out for. And also the impact of these recent regulatory decisions. That's going to hit them early next decade. So that's something that it's sort of forcing me to question the sustainability of that distribution. Horizon, well, this one's a bit like Rocky at the moment. It's taking a battering from the ACCC, from the QCA, from customers, and now from the unions. Unlike Rocky, I'm not sure if it's going to be able to come out and top in the end. Look, I'll be looking for first-time FY19 earnings guidance. I'm targeting about a 9% EBIT decline and with further earnings declines coming into FY20. So I really don't know whether you really need to be there at the moment. Look, if you're really keen, if you're looking for a value buy, where value is to me is around about sort of $4 on this stock. So it's got a bit to come down yet. ALX, this will be a half year result. We already know the toll revenue, so really it's a relatively low risk result. I recently spent some time with what they call the CEO-elect, the new CEO coming in when Macquarie management leaves. Very high caliber infrastructure professional. Those that can sort of think back in time when Transurban received a takeover bid from some Canadian pension plans during the GFC, he was the guy that led that. I mean, that's the sort of stuff that he's been involved in historically. Look, what he talked to me about is he's looking to restructure and de-risk the asset companies. And when I did some sort of crude number crunching on that could push the valuation well into the mid to high 7 range on what he's looking to do. It could require him to use some more cash than what I was expecting. So the big step up in distributions that we're talking about in coming years, maybe he actually uses some of that cash to do this de-risking, but it causes a reduction in discount rates and it means that it makes it far more palatable for a takeover bid in coming years. Personally, I don't think ALX is going to be around in the next 12 to 24 months. I think once that cleanup gets done, it becomes a takeover target or they'll look to wind up the fund. Sydney Airport, half-year result. Look, I'm expecting EBITDA up 9%. We'd already know the traffic data's already been released. I really don't think they're going to uplift the distribution guidance. Remember, this is a calendar year, financial year. I don't think they'll lift up the distribution guidance beyond the 9% growth that they've already guided for. Pretty strong stuff. Look, while historically I've been a bull on this stock, I think there are some headwinds to the very strong growth that's come through on the earnings and the distributions over recent years. But having said that, share prices come off enough that I think value is starting to emerge. I'll be buying this stock, below the $7 range. Transurban, expecting to see low double-digit EBITDA growth coming through in FY18. What'll be interesting is the first time distribution growth for FY19, and what the market's always looked at historically is the long-term incentive package that gets updated each year. and particularly the free cash flow per share compound growth on a forward basis that is within those plans. That provides a decent indication of where management and board expect growth to be going forward. Look, I'm targeting DPS growth of 7% into FY19, but I like Transurban on a business as usual basis with that valuation that I can see. The thing about Transurban is it's never business as usual. The big thing sitting out there at the moment is the WestConnex bid. That's the key short-term capital investment decision. I gave them a call yesterday just trying to get a bit of a feel for timing. We know they've announced to the market that they have submitted conditional bids, so bids conditional on FIRB and ACCC approval. The competing consortium also has a conditional bid based on FIRB approval. Just don't know whether the government's going to select somebody before those conditions, those approvals come through, or whether they'll wait till the ACCC actually comes out and FIRB comes out. For Transurban, obviously it's the ACCC approval. That's the 6th of September. Transurban has always said if they end up buying WestConnex, there will be a capital raising required. So I really think you should continue to advise your clients that Transurban is come capital raise. Cleanaway, our next one down the line there. Look, share price is on an absolute tear at the moment. It's at all-time highs. No doubt it's attractive to those with a growth bent. I've got about 10% EBITDA growth for FY18. Then as I look at the major contracts, the organic growth, the Tox acquisition, the acquisition synergies coming through FY19 to 22, I can see mid-teen EBITDA compound growth coming through. So not only that, but also they are not paying out all their cash flows. So they have this excess cash flow. What do they do with it? Debt comes down. So the equity valuation lifts with that growing earnings as well as the deleveraging of the business. So it's certainly got a growing equity valuation going forwards. Look, while I'm a fan of this business and a fan of management, it's just getting a little bit expensive for me on valuation grounds. Having said that, if you're interested, if you look at the share price going into reporting seasons, typically what you see is that there's an actual uptick when they report, and then it seems to keep on growing through that sort of first month post the result as the management gets on the road and talks to the market. So just something to watch for on that stock. It could actually push further up. Personally, at this stage, I'd prefer to buy it around that sort of $1.65 range. ERM Power, look, I'm targeting 14% EBITDA growth. Look, it's a bit of a black box, this one, I think, as we've come to realise. The market has really started to rely on these the outlook guidance that gets given by the company. So the outlook is not done on overall earnings. It's actually done on the different earnings drivers within the business. So we'll see first time FY19 earnings drivers for that outlook at the result. Look at the last report, the domestic business was going very well. The US business was absolutely hemorrhaging losses. To my way, it's around about sort of $24 million of losses in that US business. So the bull case here on this stock is that announced the result that they're shutting that business down. I've talked to the CFO about it. He said you'd be amazed about how easy it is to hire and to fire staff within Texas where they're based. So to me, it wouldn't cost a hell of a lot to actually shut it down and they'll be able to sell their book off. If that's the case, I think the stock pops to somewhere close to $2. So it's really something to watch for. My sense, though, is that they're likely to sort of hold on to the business. They're hoping to actually improve the profitability into the early years of the next decade. Invigen, my sell call in the sector, should be a relatively low-risk result because they've already reported their generation revenues for the half. My view is medium term, the electricity prices in the wholesale market are going to be coming off. We're seeing that in the forward curve. The renewable certificates, the LGCs, I think are absolutely going to collapse, and that's a big part of their revenue. And wind farms are finite life assets. So as we draw closer and closer to end of life, you actually get an MPV decay. So to me, valuation well below where the current share price is. The share price momentum is on the downside. The big unknown is that out of the blue, Brookfield bought into this company, taking out 9% of the stock at 58 cents, 59 cents. But to me, the DCF suggests that the stock is worth a hell of a lot less than that. Final one there on that table is Cube. Look, they always provide these vague earnings guidance, like we expect earnings growth, but you just don't know how much they're actually referring to there. Then we really get limited transparency on how it's performing between reporting seasons. So of my coverage, probably the highest risk going into that result. But if I dig into the container volumes going through the major container ports, container volumes have been booming. Like since GFC, they've been sort of in that sort of 1% to 2% range. Through some of these ports at the moment, they're lifting at between 6 and 8% growth. So really kicking through. Qube stands to benefit through its container stevedoring business and also its logistics business. Also, the strong commodities market that Adrian and co have been talking about, that benefits Qube because they're the guys that actually use trucks to haul product from mine to port and bring the inputs for the mining back to the port. So having said all that, the reality is the market will be very fixated on the Moorebank opportunity and just how that's actually progressing in terms of construction and getting new contracts. That adds 90 cents to $1 into my valuation. So something really to watch for. Personally, I think the stock could kick over the next 12 to 24 months. First up, Moorebank becomes operational first quarter next year. And I think by late this decade, early next day, there will be a takeover bid come through from Qube. My guess is it'll actually be Brookfield, the co-owner in the stevedoring business. So